Good evening, everyone, and welcome to our insurance recovery webinar series. Thank you for joining us this evening. My goal is to help walk you folks through what to expect as your claim progresses, how your policy is going to unfold, help you better understand exactly what the different coverages mean in your policy so you can connect the dots between what the insurance company is doing and how they should be performing. This evening, I'm going to kind of glance through the coverages. We do 2 of these per week. This week, we are going to focus a little bit more on building estimates and personal property, which seems to be quite a topic still even this far into the claims process. Before we start, I'd like to go into a little bit about who we are and what we do. My name is Richard Villanueva. I am one of the vice presidents of Adjusters International. I'd like to say that I am not a professional presenter, so bear with me as we go through this journey. Who are we? Well, Adjusters International is a local company. We've been serving the local needs for 30 plus years here in Colorado. We're based out of Westminster. We're part of a much larger firm. It's the largest public adjusting firm in the entire country and most respected. And with our joint partnerships on the West Coast and our Pacific Northwest partners, we bring just about 75 years of wildfire and just fire claims experience in general. And we've allocated 100 plus of our teammates to this particular event, all experts in their specific disciplines. What we do is represent the insureds. We've represented thousands of claimants. We're licensed by the Department of Insurance or the Division of Insurance, and our role is to act as your advocate. In the same way the insurance company has their adjuster representing their interests and preparing all of the documentation to support their position, we prepare, present, and negotiate your claim from the lens of the insured. So when we look at a loss, we look at the loss through how it should be responding and what is the best financial path for the recovery for our particular client. So that said, I'd like to jump in and get to our first slide here, which is just kind of an overview of coverages, folks. If you were to take your coverages and basically break it down to have it look like a pie, this would be what your coverages would look like. Every one of these will apply to you, some more than others, but everybody in your policy, you should all have your declarations pages by now. You should also have requested a certified copy of your policy from your insurance company. Folks, I cannot stress enough how important that is. The certified copy, just so that you understand the importance, is the latest and greatest version of your policy with all of the potential changes made not only by the carrier, but maybe by any of the governmental entities that oversees the carrier. And you need that latest version of that policy because we've seen in many cases with this particular firestorm, you have the declarations page. It's referring to specific forms in the policy, and unfortunately the forms don't exist because they don't have the certified copy. So you have to be able to connect the dots between the form and what language change might be in that particular form, because it may change the way the policy performs as a whole. So again, folks, in an email, send to your adjuster the request for a certified copy moving forward. So all of the policies have these particular coverages in them. They all have a dwelling, which will be coverage A. Some of them will have an extended limit to that dwelling, which we'll get into a little bit later. You all have personal property, which is at the actual cash value. Many of you will have a replacement cost policy for your personal property. You will all have separate structures. And in some cases, if you're looking at a declarations page and you are a State Farm insured, extension, dwelling extension will be what your separate structures will be referencing. Code upgrades, additional living expenses, debris removal, and trees, plants, and shrubs. So those are the breakdowns of the different coverages that all declarations and all policies will provide moving forward. This next slide is really just an overview of your coverage A. We're going to use $1 million as a base limit. And when you have these types of wildfire events, folks, you typically have three primary options afforded to you. And depending on how you choose to move forward, the policy will respond differently. So you all of you have the option of not rebuilding. You have the option to purchase a replacement property in lieu of rebuilding, or you can rebuild on site. Each one of those will require a different strategy on the front end of your claim. Each one will require a different narrative as you start communicating with the insurance company. And you want to strategically position yourself accordingly. So if either of you or anybody out there has very specific questions about how you may want to navigate some of that language, I'm happy to have either a Q&A at the end to address that specifically, or you can always reach out to us directly and I will spend whatever time you need to make sure that your questions are answered. So in this particular case, we're going to use $1 million as a base limit. In that base limit, whether you perform to rebuild, whether you purchase another replacement property, or whether you rebuild on site, the base limit stays the same. It's not going to change. In additional monies on top of that $1 million base limit, you have built in as an additional amount debris removal, and that equates to 5% of dwelling A. So whatever your coverage limit is, and we're just using $1 million here as an example, add an additional 5% for your debris removal. That debris removal is afforded to you whether you rebuild, whether you replace the property, or whether you don't rebuild. Those three options, the debris removal does not come and go. It is afforded to you regardless. On top of that, you also have an additional 5% for your trees, plants, and shrubs. Again, folks, you don't have to perform. It's all based off how bad the damage is. Now, there are some policies that we've seen in these recent reviews where some of the language is becoming very specific and it is defining a distance from the home. So I believe it's in some cases 250 feet from the dwelling. If there's trees, plants, and shrubs within that 250 feet, the landscaping will kick in. So again, it's an additional 5% of the dwelling. Whatever your dwelling limit is, you're going to apply the 5%. Now, this is where some of the coverages start to change. When you have a policy for coverage A, you have, in many cases, what's called an extended replacement cost endorsement. For those of you who have an extended replacement cost endorsement, this is how that works. If you do not rebuild, the insurance company is not obligated to pay you the extension of your coverage A. If your loss is not measured, this is the key, folks. If your loss is not measured above your base or stated limit in your dwelling coverage A, it will not unlock that secondary extension of coverage. It is critical to understand, which we're going to get into when we start talking about building estimates, why it's critical to understand exactly how the insurance company is measuring your loss. So if you choose not to rebuild, the most money that you will ever get is an actual check in your hand, provided the loss is measured up to that amount, is your base limit or your stated limit. That's another term that you'll hear quite a bit. If you have an extended replacement cost, and in this particular example, we're going to use 50%, and you measured your loss, or the insurance company measured your loss above your base limit, it will unlock that extension, and it will always represent a percentage of your dwelling coverage. So in this particular case, we're using 50% as an extension. So if you choose to purchase a replacement property, you could transfer that extension of monies that you're entitled to into the purchase. But again, folks, it requires a very specific upfront strategic narrative and agreements with the insurance company as to how they intend to transfer those monies into that purchase. If you choose to rebuild on site, you are entitled to your extended replacement cost. Again, if it was measured above the policy limit, and we're going to get into that, you would be entitled to your 50% extension if you were rebuilding on site. Some of you may even explore the option of rebuilding somewhere else in the country off-site. Before making that decision, folks, I would caution you, you want to make sure you're really reading the language of that contract that you're in with the insurance company. You want to make sure that the insurance proceeds and all the provisions that are afforded to you will transfer to that particular decision. Sometimes it states clearly that if you do not rebuild on site and you choose to rebuild elsewhere, that you are walking away from your extended replacement costs. So you want to make sure that you're being strategic in that approach. Additional increase due to declared catastrophe. Now, I have yet to see one of these policies, and we have reviewed hundreds of policies over the last couple of weeks. In some cases, depending on the carrier, if you have a declared catastrophe, there is specific language in certain policies that will literally double that extension. And in this case here, from 50% to 100%. So it may double your base limit. But I have not seen any of those yet. It's on a case by case, and you would certainly want to look deep into the policy to see if that language applies to you, but I have not seen one as of yet. Code upgrade is also an additional coverage that you're entitled to. It's typically represented by 10% of the dwelling. In some cases, it could be 20%, but again, in this particular case, if it was a declared catastrophe and your policy language supported that, it may bump your code to 100% again of the coverage A. So, but most policies, and I would say the majority of the policies represent 10%. Now, what does that mean? Code, again, if you don't rebuild, you're not entitled to those monies. Code is what we call a use it or lose it bucket of money. And so code would be anything driven by the building department or any code related upgrades to the property. So let's say you didn't have sprinklers in your home. Now you're required to put sprinklers in. Whatever the cost of that sprinkler expense would be, would come out of that code related bucket. Again, so if you're purchasing another property, and that purchased property needs some upgrades and you need to bring that property up to code and you have that money available to you. In many cases, you can transfer some of that code money into the new purchase and bring that property up to code. And again, if you're rebuilding on site, 10% of your base limit typically goes in addition to code. So you want to make sure you have specific code coverage and make sure you're going through your declarations page and it says this is an additional coverage, because some language will state you may use up to 10, 20, 25% of coverage A. That is not an increase in coverage, folks. That's basically saying if you have $1 million and you have 25% that you can use 250,000 of that million towards code related upgrades or code related expenses. So that's coverage A. Now we're going to jump into coverage B. Again, for you State Farm policyholders, this would be what you would see dwelling extension. But for most other policies, coverage B is referenced by other or separate structures. I've had many conversations with a lot of people who have lost homes who don't really understand what other structures represents. And so we thought it was important to kind of cover that here. Other structures is typically always representative of a percentage of coverage A. In this case, we're going to use 10% of the million, which would be 100,000. A visualization would be if you were to take your home and you plucked it off your property. Typically, anything left remaining on the property would typically fall under other or separate structures. In this case, garages, workshops, detached fencing, retaining walls, walkways, driveways, folks, especially custom driveways, pavers, and things like that. Sprinklers, exterior lighting, pools, for those of you who have pools, cabanas or, pool houses. And when you're looking at that and you're looking at all the different items that would fall under that category, typically 90+% folks are usually underinsured in that particular bucket. Most of us who have some property or have some land and you're doing a shop or you're upgrading your exterior, we tend to forget to tell our insurance company or our agent that we've made these additional changes to our property and add that additional coverage to the policy. So most cases, from what we've seen so far, a lot of people are either right at where they need to be or underinsured in total. I've not seen anybody that has more money than they need for that particular bucket. In some cases, there is some endorsements for your extended replacement cost. There might be some language that states that the extended replacement cost endorsement that you folks are entitled to for coverage A will also apply to coverage B. Again, reading the language of that certified copy of your contract or policy is critical to really understanding at the forensic level how the policy is expected to respond. Because if you don't understand how it's to respond, you're not going to understand the position the carrier is taking when they start talking to you about your settlements. In addition to, you are also entitled to 5% for debris removal for your other or separate structures. In this case, 5% of 100,000 as the example is 5,000. And in many cases, you're entitled to your code upgrade for other structures as well, typically representing 10% of the number. In this case, 100,000 would represent 10,000. So in total, for this example, you would have $115,000 available to you, not only just with the coverage B, but with your debris removal and also your code upgrades that might be required for whatever that separate structure is that you're building or replacing. We're going to jump into the next slide here. This is the one, folks, that most people have a tremendous amount of question and most uncertainty about. Personal property. The insurance companies don't make it easy. A lot of the carriers are now working directly with the insureds. We're seeing that there are two primary ways that the insurance companies are allowing insureds to prepare their personal property. One is through a line item inventory where you have to recall every single line item that was lost in your entire property. The other is a category inventory. The category inventory, folks, is a very fast way of producing a personal property list, but you are definitely going to leave money on the table when you do that. It is not an accurate assessment of what you've lost. You're grouping a bunch of your personal property together, clothing, sporting goods, kitchenwares, and you're trying to throw a value on that, and that can become problematic for you in the long run if you're looking to maximize your policy. So in this particular case, folks, we're going to use, and I'm going to jump back to these different categories or the different methods of how you can produce your personal property. But in this case, we're going to use $500,000 as your base limit for personal property. Now, in some cases, in most cases, you will have sub-limits to your personal property. There have been some confusion. There is some confusion in the community about sublimits, and you see it in there, and it'll say jewelry, it'll say firearms, and folks, those sublimits for those particular categories typically apply to theft. They don't apply to fire. The things you will find in your sublimits will be business personal property. If you ran a small business from your home and you didn't have business coverage and that item that you lost was specific to your business, there will be some sublimits for that particular item. Watercraft will have sublimits. Cash will have a sublimit. Some collectibles, stamps, coins, things of that nature will all have sublimits. So just be aware of what it is you're listing on your personal property as you submit to the carrier, and understand in advance what might have a sublimit attached to it. In some cases, there are also what we would call scheduled items. A scheduled item would be a high dollar item that might represent in its value a large portion of what your overall personal property coverage might be. And it would not be wise to have one item consume the majority of your personal property coverage when you have an entire house full of stuff. So an example to that would be, let's say, a Steinway piano that might be $100,000. Well, in this case, that would be a fifth of its value. So you would insure that separately for its value, and you would pay a small premium to do so. So that's what a scheduled item is. Very few policies have it, but we have seen a few here in this event, but not too many so far. We're going to talk a little bit about actual cash value versus replacement cost value. And it goes back to either a category inventory or a line item inventory. The most that the insurance company is obligated to pay you when they are settling their claim for their payment for your personal property is the actual cash value. That is the dollar amount that they owe you before you actually replace an item. Actual cash value, folks, is nothing more than replacement cost value minus depreciation equals actual cash value. Some of you have only actual cash value policies, and most of you will have replacement cost policies. So we're going to get into a little bit more in this next slide how those two categories will play a role in your overall recovery for your personal property. So there are some pretty common questions when it comes to personal property. Do I need to list every item? Well, again, it goes back, folks, to what you intend to do. Are you going to do a line item inventory, or are you going to do a category inventory? The advantage to the category inventory, again, is it's far less time consuming, but it is not accurate. And if you don't think that you have enough line item inventory to get you to your personal property limit, then category inventory can get you there faster if you don't think you're going to get anywhere close to the policy limit. If you think you have enough personal property in what you've lost to get you to your policy limit, then I absolutely encourage you to take the time and do a line item inventory. Again, folks, we're here to help and to be a resource for you. We have amazing tools. If you're interested in some of these tools to help you get to the finish line, certainly send an email. We're happy to send you whole house guides, which are lists of up to 4,000 different line items that will help jog your memory, and samples of inventories that we would produce for clients so you can see the format. To put it in perspective, when we are doing personal property inventories for clients, it can take literally, with a team of professionals, 4 to 6 months, depending on the size of the home. So if you're doing this on your own, give yourself the time that you need. It could take 8 to 9, 10, 12 months, depending on what you have. So do you need to list every item? In our recommendation, yes. I think you're going to fare much better if you are doing a line item inventory than if you do a category inventory. What is a holdback and how does it work? So most people don't really understand what full replacement or recoverable depreciation means. There's different terms for it, but primarily it's called recoverable depreciation. So again, folks, your actual cash value is nothing more than your replacement cost minus depreciation equals your actual cash value. Here's how that works. If you had a couch and you spent $1,000 on that couch and you lost the couch, and the insurance company has a magic database that they're looking at that says, hey, this couch has a 10-year lifespan. You spent $1,000 on the couch. It was 5 years old. We are going to give you $500 of that $1,000 that you spent on the couch. And when you spend that $1,000 to replace the couch that you lost and give us the receipt that you spent $1,000 on the couch, that $500 in recoverable depreciation that they're holding back, they will reissue that to you. If you don't replace that couch and they pay you the actual cash value, the depreciated amount of $500, and you find that couch for $500, the recoverable depreciation, the money that the insurance company is holding back, remains theirs. So you want to be very strategic about your approach and understanding what it's going to take to get you to the finish line. Well, on an average, most insurance companies will apply 35 to maybe 40% as an average percentage of depreciation across the board. Well, what does that mean? That means that if you have a policy limit of $800,000, you will want to get above that policy limit in the valuation of what it is that you are trying to record as of what you lost, in value of 35 to 40% over your policy limit. Because what you're trying to do, folks, is you're trying to get the policy limit and so far beyond that after that depreciation has been applied, the goal is that the actual cash values, the dollar amount that they owe you, is either at or just above your policy limit. And it forces the insurance company to cut you a check for your policy limits, because the last thing that you ever want to do is get into the receipt game with the insurance company, because they know you are not going to replace 100% of what you lost. And so what you don't replace, they get to keep the recoverable depreciation. So you want to take your time and get as far over your policy limits as you possibly can. So in these examples here, we're going to use just a simple spreadsheet that most people can understand. We're going to have a quantity. We're going to have a description. When you start listing your personal property, folks, be as descriptive as you can and don't leave anything up to interpretation. So if there's a specific manufacturer of clothing, like in this case, women's jeans by Ryder's Vintage, that jean will cost $100 to replace today. And remember, it's not what you folks paid for an item when you bought it. It's what it would take to replace that item in the market today. So as you're doing your research, use the numbers and the replacement cost for where you would typically shop. Don't jump into the discount sites. You want to get as far above over your policy limit as you can. Discount sites are not going to get you there. So in this particular case, today's replacement cost for this pair of jeans is $100. The source is Macy's. Your source could be whatever it is. The depreciated amount is 50% based off its age and its condition. The actual cash value, which is the dollar amount that the insurance company owes you, is the $50, and the withheld depreciation is $50 because the value of that line item was $100. So since it was depreciated 50%, they're only going to give you 50% of its value until you replace that item. And the same would apply to the rest of these examples. It can be a little confusing, folks, and the more specific you are in your approach to your personal property, the better your overall recovery will be. Take your time, don't rush. You've got 2 years to get this done. And you want to really make sure you're putting as much data as you possibly can when it comes to pricing those items out. All right. Inventory tips and tools. Well, folks, these are just some things that we suggest. Certainly, keeping a pad and pen with you at all times in your car, at your temporary location, at your hotel, whatever it is. That having your kids have pads next to them, because if something comes up, you just want to get it out and get it on paper. It is going to be critical to get it out, and then you can kind of fine tune what category that item should fall into. Draw each room one by one. A more advanced way to kind of take a look at your personal property would be if you had a multi-storied home. We recommend you need to change the way your mind's eye is looking at the interior of your home. Typically, we walk through our home and our mind's eye is taking us through the house as we would typically walk through the house. But that's a skewed look into the home. You need to change how your mind is looking at your property. So what we recommend is draw an outline of an aerial perspective of each floor. Your top floor, set it off to the side. Your first floor, the same, set it off. You want to capture each room, where the closets are, where the beds are, where the dressers are. And as you do the aerial perspective, it really does change the way you're looking into the home. Gives you a much bigger perspective. And when you're looking at a specific room, folks, it helps if you take that room and you break it down into quadrants, right? Just 4 smaller boxes, and then jump into one quadrant and work clockwise in that one small quadrant and go up the walls and down the walls and across the floor, and then move to the next quadrant and the next and the next. And by the time you get through all 4 quadrants, you're more likely to capture much more of your personal property than you would if you just walked into the room when all of this data is jumping out at you and you're trying to make sense of it and get it onto some spreadsheet. Visualize your dressers, your drawers, your end tables, or your side tables. What was in the closet on the top shelf? What was under the bed? Take the time to really kind of fine tune what you think you had in those areas. Use family and friends, folks. It is really critical that you rely on others to help you through this incredibly difficult time. Everybody would like to help, and we encourage that you allow them to do so. When you're looking at pricing potentially 2 to 3, 4,000 line items, that can become quite daunting. So if you have friends and family and you say, hey, would you mind pricing 50 items for me, and they're just tools, or there's all your cookware, whatever it might be. Also, it might help if you set up a drop box where friends and family, anybody that may have been over your home that has celebrated Easter's or Christmas, Thanksgiving, birthdays, whatever, and any pictures that they may have taken, it might be very helpful for them to just start dumping these pictures into your Dropbox, because not only do you see your personal property in the background of these pictures, but it also helps if you're going to be working with your adjusters to make sure that they understand the quality of what you had in your home. It may show the hardwood floors in the background, or the crown molding, or the granite or marble countertops that you may have had. And you want to make sure that your interior is being represented fairly when they're determining the value of what they believe they owe you. Again, the documentation for your photos is critical. Pull it from the cloud if you can. Most iPhones and most smartphones now, data dump and take all of these pictures from your phone, and you might be able to pull all that down, even if you lost your phone in the fire. So the next is loss of use. And you have additional living expenses versus fair rental value. What is the difference, and how does it apply to your housing? Most people are opting in for the additional living expense. It's your temporary housing, folks. You are entitled to what you had, and you're entitled to maintain your normal standard of living. That's the key phrase right there, folks, your normal standard of living. Don't compromise your comfort because you think you're doing the insurance company a favor, just because you're taking less per month. You want to be very strategic about your approach to your additional living expenses. Now, there are a lot of different options, which we're not going to get into here. If you're interested in really exploring how to pursue your additional living expense, certainly I'm happy to talk to you offline as it may apply to you specifically. But temporary housing always falls under your additional living expenses. Also, any furniture rental costs. So if you're moving into a temporary location, the insurance company is also obligated to cover a furniture package to fill that temporary house if where you're moving is not already furnished. You are also entitled to increased mileage. Let's say that your temporary home is farther away from your workplace. You would want to start recording how many extra miles you are driving per day. There's a great app. It's called Mile IQ. I know it's for Apple iOS. I don't know if it's for Samsung and Android, but it is an app that immediately starts to track your mileage as soon as you get into the car. And at the end of the night, you can just swipe one direction for business and swipe another for personal, and it will track all of your mileage. And then you can submit those additional mileage files to your carrier at the end of the year, and it might represent another $2,000 or $3,000. So it does make sense to pay attention to your mileage. Folks, if you had RVs or boats and you stored them on your property and they were not damaged, but you no longer have somewhere to store them, you certainly want to have a conversation about the expense of storing them. It's a cost you would not have otherwise incurred if you did not suffer a major loss. It would come out of your additional living expenses. Animal boarding, folks, if your animals are being taken care of by family, by friends, if you have them in a boarding facility, your personal friends or family are entitled to be paid while they're taking care of your animals, in the same way that they would be paying for a boarding facility if you had to house your cat or animal, or horses, even for that matter. And your policy is going to be driven, in most cases, by either a dollar limit or an amount of time. You want to understand, folks, what is driving the dollar amount or the amount of time, because everything you do is going to be related to that particular bucket. You want to make sure that you're performing in the amount of time that you have, if it is time driven, to either replace or repair or rebuild the home. Or if you have a dollar amount, you want to make sure that what your monthly expenditure is does not exceed what you have in your coverage. And you want to try to stretch that out as far as you can. I would say at a bare minimum, you would try and have that money cover you for at least 2 years if you can. You certainly don't want to spend more than you need, but you want to make sure that you have enough to cover you for close to the 2 years if you can, because this is going to be a long event. Fair rental value, for those of you who are going to opt into your fair rental value, first and foremost, if your policy even has the language. Fair rental value really just means it's what your home would have rented for prior to the loss. So assuming for a moment you can't find temporary housing that suits your needs, there's a home that you can't, it's just not large enough, or it's just too far, and you have a fair rental value clause in your policy, you can opt to have the insurance company just pay you monthly for what that cost would have been. And then you are obligated to find housing on your own, and however you spend that money is entirely up to you. Now, the carrier will want to start to see you perform, and you're going to start to see some form letters come your way, probably within 6 months to a year. They want to see that you've engaged with an architect, or that you've started your plans, you are communicating with a contractor. Everything is based around the period of restoration. That is what the insurance company believes is a fair and reasonable amount of time for you to replace or rebuild your home. And they will start to put some pressure on you and leverage your housing monies against that time that they believe it should take for you to replace or rebuild or repair. Carrier does owe for increased costs due to limited housing. And what that would mean is, let's say that before a wildfire event, a 6,000 square foot home would rent for $7,000 a month. And now you've lost your 6,000 square foot home, and the only homes that you can find are now $9,000 a month. Well, the insurance company is obligated to pay increased costs due to limited housing, because now there's 1,000 families that are looking for housing, and there's limited housing available. So the cost goes up for supply and demand, unfortunately. So that's kind of how the additional living expenses work, and fair rental value works. Most of you will be using your additional living expenses. Few of you will be using your fair rental value. Who can represent you? It's a great question. We get it all the time. There's a lot of inaccurate information out there, folks. Really, the only two entities that can actually represent you are attorneys. Attorneys don't do what we do, and we don't do what attorneys do. Attorneys tend to take a reactive approach to a claim. They wait for the carrier's position, and then they try to negotiate from where the carrier is positioning themselves. Public adjusters licensed by the Department of Insurance, we tend to take a much more proactive approach. We believe that preparing the appropriate documentation and supporting that documentation with defendable data to support what is behind the valuation of what our clients are entitled to is a better approach, in our opinion, in recovering far greater settlements overall. It makes it very difficult for the carriers, the insurance companies, to dispute that position when you have defendable data in front of them. Contractors cannot negotiate claims, and your insurance agent and your broker will never get involved in your claim. And if they do, it's for just making a phone call here or there. The Department of Insurance, which is the same governing entity that issues the license for your insurance agent and your broker, oversees and regulates how they do their job, and what they're allowed to do is the same entity that governs us, and they are licensed to sell the product. We are licensed to negotiate the settlement of that product. but still licensed by the same departmental entity, which is the Department of Insurance. So I want to take a few minutes and jump into the building estimate and personal property. Families tucked in, how do I prepare a building estimate? What do I need to do? Should I let the insurance company do it for me? Now, I know we've got quite a few questions. And so I'm going to cover these questions because they are directly related to building estimates and the building in general, and also personal property, because I've been seeing them pop up. So if I may, I'd like to just jump in. This one is about personal property. What if I had an item that was like new, but it was 10 or 15 years old? How is that priced? That's a great question, folks. So what if you had a piece of artwork? What if you had a sculpture that was sitting on a shelf that was cleaned and there's really no damage, there's no use? How do you apply the appropriate depreciation to that? Well, depreciation, folks, is subjective. It's nothing more than a negotiation, and it's certainly up for debate. And you do not want the insurance company to just wave a magic wand over your personal property and determine what they believe your depreciation should be. Depreciation now is based off age, condition, and useful obsolescence. So an example would be if you had a spare bedroom and you had furniture in the spare bedroom. It was 10 or 15 years old and you never had any guests. Well, it's like new or excellent. So you would depreciate that very little, not based off its age, but based off its condition. So certainly you want to control the age and conditioning of your personal property. Should we be concerned if we're being told that we're getting policy limits for our dwelling? Well, folks, let's talk about that a little bit. A lot of you, and I've had many conversations, several today actually, that the insurance company is reaching out and they're telling you they're paying you policy limits. Look, that's great, and I hope that they do. But what does that mean when they say they're paying you policy limits? Folks, if they pay you policy limits, but they don't measure the loss, your loss, above your stated limiting dwelling A, it will not unlock that secondary extension that you are entitled to, your extended replacement cost endorsement. So do not be seduced by the fact that an insurance company is telling you that they're paying you policy limits. If they've measured your loss under or just at policy limits, they've locked you out of your extension, and you are now going to have to figure out what you need to do when building your estimate to get you in and over your policy limit to unlock that extension that most, if not all of you, are absolutely going to need as you move forward. Whether you're purchasing another property or whether you're rebuilding your property, that is going to play an instrumental role in your recovery. So you've got to understand how their position is going to affect you. The other thing is, you would never, ever want an insurance company to say, hey, we're going to pay you policy limits. And then as you start to rebuild and get into the reconstruction, or when you get ready to buy a replacement property, we'll discuss what monies might be owed to you then. Look, folks, under normal circumstances, you would never put yourself in a financial position like that. That would be like buying a brand new vehicle that you weren't even aware whether or not you could afford the vehicle, and you're just having the dealership drop it off, and you're waiting for the monthly payment to come into the mail, and you don't even know if you can afford it. You can't responsibly enter into either a purchase contract for a replacement property or a rebuild with your contractor if you don't have a negotiated budget with your insurance company. You've got to understand where they're at and what is it going to take to get you to your policy limits. Extensions, not just the policy limit, folks, but your full extension that you're entitled to. What happens if we don't get to policy limits and we don't replace some of our items? Is there any way to get that depreciation back? Unfortunately, no, folks. If you don't perform and replace that property and your personal property limit does not exceed your policy limit, if the product that you're producing doesn't get you over the policy limit, and the actual cash value that they owe you is not above or at your policy limit, if you don't replace the item and you have a replacement cost policy, then the insurance company will hold that recoverable depreciation, and they will end up keeping that. So it's critical. What are our options if we want to change what we had during the course of our rebuild? How will that affect my recovery? That's an excellent question. That's going right into the building estimates, which is one of the topics this evening. You have to know, folks, remember, you're in a contract with the insurance company, and you have to know how to navigate that language. And there is a lot of strategery that is involved when positioning yourself accordingly. Can you rebuild larger? How does that affect? Can you rebuild 2 structures on your property instead of just 1? What if you want to build something smaller, and how does the policy respond to that? What if you want, how does the code apply to something that's different than what you had? Because remember, folks, if you don't have a mortgage, you have a lot of freedom to do what you choose to do, but you've still got to understand how the policy is going to respond to your decision, rebuilding, buying another property. If you do have a mortgage, that's a whole nother issue. First and foremost, I'm assuming that you've all notified your financial institution that you've had a loss. They may have some specific guidelines that are going to need to be followed because they own the asset and they want to see that asset brought back to the way it was prior to the loss. And so they may have some input as to what you're rebuilding. You may have to follow some pretty strict requirements. So you certainly are going to want to have a conversation with your financial institution to find out, A, is there guidelines that you have to follow? And then you'd want to know, how does my policy respond to those guidelines? And you want to navigate within those parameters and make sure that you're maximizing that recovery. So you do have options. Mortgage is going to, potentially limit those options. If you don't have a mortgage and you're clear and free, then you have greater options. And, I'm happy to discuss more strategically what those options would be one-on-one, but it's all policy specific, it's carrier specific, and it's coverage dollar specific on how to navigate those dollars. Do we have to rebuild what we had? Again, the bank may have some input on that, but typically if you don't have a mortgage, you can go back with whatever you'd like. The key here is the carrier only owes you, folks, per the contract, what you had 5 minutes prior to the loss. So if you had a single story and you want to go 2 stories, that could be problematic. Can you do it? Absolutely. You can do whatever you'd like, but you just need to understand how is the policy going to respond to what it is you want to do, because you want to be strategic about the flow of those monies. You want to make sure that you have an understanding with the insurance company well in advance of committing to that path. And before having the discussion with your insurance company, you would want to navigate that language and make sure you know how to prepare the appropriate narrative to support whatever path you intend to take. Can we split the dwelling money and build 2 smaller homes if we wanted? Again, folks, it goes back to whether you have a mortgage or you don't. If you get $1 million settlement and that is your policy limit and the insurance company has made you whole and that's all you had, and there's no more monies to collect from the insurance company and there's no mortgage, then how you spend that money, folks, is entirely up to you. Can you explain what Xactimate software is? All right, folks. So Xactimate is what we call the language of insurance. It is a software system that was designed by the insurance industry to support the insurance industry's interpretation of what they believe the value of the loss to be. It is nothing more than a template, and it is only as accurate as the data that is input. So to put it frankly, if it's garbage in, it's garbage out. So if your adjuster that is from out of state is preparing your estimate for you folks, just to kind of simplify the position that you're in, your entire financial recovery as it relates to your dwelling coverage is solely dependent on that one adjuster's interpretation of your physical data loss. So however he's taking or she's taking the physical data and transferring it to your the Xactimate software system, If it's accurate or inaccurate, it's going to spit out a number, folks, and you're going to be left to deal with that end number and understand how to get the carrier to move from their position. So how do you get the carrier to move if they write an estimate that's under or just at your policy limit? Well, folks, the reality is you're going to have a problem getting them to that number, because you can't rely on your contractor to write an estimate and submit that estimate, because that's going to be in a different language. Most contractors don't write estimates in the software that we use in the industry. And the carrier doesn't have to take your contractor's estimate into consideration. And it's also important to know, folks, that if you have 4 different contractors looking at your project, you're going to get 4 different numbers, because each contractor is going to look at your particular product through their business lens, which is a fair statement. Do they own the equipment? Do they lease the equipment? How much do they subcontract out? What do they pay their employees? Do they own their building? Do they lease their building? I mean, there's so many variables that they're building into an estimate. So the only way to really level the playing field is to have an Xactimate estimate written on your behalf at the forensic level, which now becomes defendable data that the insurance company has a very difficult time disputing. And when you get the carrier to commit to this particular product, now that will drive the budget, because the more accurate the scope of work, the more accurate the data going into the Xactimate software, the more accurate the back end number, which is what's creating your recovery budget. You can then use that product to have contractors bid against. So that way they're all looking at the same apple. You can remove the financial component so that nobody knows what you're getting as far as your financial recovery. But as far as the data in your scope of work, that is what's defining the estimate, you would want to make sure that you had the same apple going to each one of the contractors, if that's what you're intending to do, and bid multiple contractors. Is there any harm in trying the faster process for contents to see if you can get to limit? And then if that does not work, go to the detailed line item approach if the streamlined approach fails. Folks, I would recommend, if you're going to take that approach, you're better off just taking your time and doing a line item approach. Is there any downside? Well, the downside is that you've now created a product that defines the majority of what it is that you've lost. The bullet has left the barrel, and you're going to have to go back and redo all of that and justify line item by line item exactly where the difference lies and why you're entitled to these additional monies. I can't stress enough, and from our professional perspective, if you have a high dollar in your covered C for personal property, it is always in your best interest to take your time and do a line item inventory. And the way that I would encourage you folks to kind of look at that process, because it's very daunting, it's taxing, it's time consuming, it's not fun. And it's probably the most frustrating part of the entire claims process, next to rebuilding the structure or buying another house. Look at it this way. If you had 500,000 or 600,000 in your personal property, and I were to say to you, under different circumstances, hey, would you mind working 1 hour a night for me, 5 nights a week? Take the weekends off and do it for 45 days. Just work 1 hour a night, 5 nights a week, take the weekends off for 45 days, and I would pay you $600,000 or $700,000. Look, under normal circumstances, folks, that's what you would do. So give yourself a certain amount of time each night. Don't overdo it. Stop when you're done and you're getting tired. Have a process in place and allocate a specific amount of time so it doesn't become overwhelming, and take your time, because you have a tremendous amount of money. And for some of you, in fact, quite a few of you, it is going to be imperative that you maximize your personal property recovery, because a lot of you are going to have to repurpose a lot of the money that you get from your personal property into the dwelling, for those of you who are underinsured. So you're going to need to rob Peter to pay Paul, just to make sure that you're able to replace what you've lost. We were on a call with the city we were on a call with the city or county, and the insurance commissioner said he'd be pushing for state help to eliminate the requirement for personal property inventory. Have you heard anything about that? Yes, folks, we have. But you have to remember, the Department of Insurance can strongly advise the insurance companies to do right by the insured, which would really be to pay policy limits. Excuse me. But you need to remember, folks, you're dealing with a business, and your insurance companies are typically privately held businesses. So they can't be told what to do, and the department cannot tell the insurance companies how to run their business. What they can do is give them the guidelines and the parameters to operate within. They can strongly advise that they do certain things, but they can't dictate how that business is to run their business. So for those of you who are being told you're getting policy limits for your personal property, there are some carriers out there that are doing so, and that's fantastic. But that is a minority, folks, of who we're working with and who we're communicating with daily. They're either just giving you small advances, 30, 50, we've seen 80%. Again, don't be seduced by the advance, folks. You need to understand what that means. When you receive an advance for your personal property, when you submit the personal property product that is generating what you're owed, you first have to submit something that justifies the advance. So again, going back to the line item inventory, never turn your personal property in until you have gone through it again and again and again, and you have fine-tuned it and it is done. Don't piecemeal it. Don't send it in chunks. Hold on to the product, work through it, and make sure it's accurate, and then submit it all at once. It will garner a much greater return in the long run. And you don't want the carrier to start piecemealing your personal property, and they start focusing on the high dollar items. And then they start fine tuning what they think their depreciation is going to be on those high dollar items. And it kind of sets you back even further, because now they're not paying you what you're entitled to. So give them defendable data, do it all at once, be specific, be strategic, be forensic, take your time, and make sure you're maximizing that particular coverage. I own a rental property. I can have the current tenants move out and move into the rental. Can I claim ALE equivalent or larger on the rental property's usual rental price? How can I reflect the sudden scarcity in the market in the rental price? Well, folks, look, again, you want to go back to your policy, but there should be nothing in the policy that states you cannot rent your own property back to yourself for what the market would call. And if the market is calling that there's a general increase across the board and you could have rented that property out to anyone else, then you should be entitled to rent that property to yourself as well. Now, the carriers don't like people to profit from a loss, and there is very specific language, but if you have a property, you absolutely, in most cases, can rent it to yourself for whatever the market value would call for. So even if you were renting it for $5,000 a month, and that tenant is now that you've terminated the lease, or they've terminated the lease because they're moving, whatever the case is, or the lease is up, and now you either have the option of renting it out to the market for another family that may have lost a home, or renting it to yourself, and the policy will respond favorably. Certainly, you would want to make sure that you're reading the language and then positioning that conversation appropriately with the carrier and get that approval in advance before you start making those kinds of plans. And again, folks, be careful when you have, very open discussions with your adjuster. Make no mistake, they represent the insurance company, and they represent the insurance company's position. They're hired by the insurance company. They're paid for by the insurance company. So be strategic in your communication, right? You want to know how the language is going to respond, and then prepare the narrative to navigate and operate within the language of the contract that you're in. And that's the advantage of, again, having an advocate, whether it be public adjusting firms or attorneys. We have the luxury of taking a step back. We look at the language of that policy. We understand what the options are. We define the path that's going to create and produce the greatest financial return based off what our clients' wishes and wants are. And then we execute the strategy to get you to the finish line. And so you're always better suited understanding how the language of your contract is going to perform. Pricing now and pricing within 365 days after ALE or move it will change how that is handled. Let me read that one more time. Pricing now and pricing within the next 65 days after ALE or move, it will change how is that handled. I'm having a hard time. Do you understand that question? I'm sorry, folks. If you can send that in again, I'm having a hard time understanding what the question is. Pricing now and pricing within the next 365 days after ALE or move, will it change how that is handled? So if I'm understanding maybe what the question is, pricing now for what you're entitled to, and then you move after 365 days over the next, let's say you're in temporary housing for a year, and then you're moving again after the year because your home isn't replaced or rebuilt. Does it change? Absolutely. If the question is what I think it is, the price is driven by the market. If the market is different and there's no available inventory when you go to move, if you're only in a lease for a year and all of a sudden the ownership of the home says, hey, the lease is over and I'm not renewing and I'm selling the property, and now you're forced to find new housing, whatever the market condition is at the time you go to find new housing, absolutely the policy is going to respond accordingly. So it will change how it's handled, and certainly you'd want to be strategic before you get to that point well in advance. If you have to replace something, my $100 jeans, then show a receipt to get the carrier to pay full replacement cost, then how can you apply personal contents funds to replacing your dwelling? So again, folks, you have parallel running claims, right? So just because you have one claim number, because you have basically four buckets of money, each one of those has to be prepared and presented independent of itself. So as you're strategically positioning yourself for your dwelling recovery, and you're strategically positioning yourself for your other structures, you are equally strategically positioning yourself in your personal property. So by the time you settle your personal property portion of the claim, which will be months from now if you're doing it correctly, by the time you get to that point and you find your final settlement, you can transfer those monies as long as you get the policy limit, however you choose. And even if you don't get to policy limits, folks, so it doesn't really matter what you do with the personal property money. It's your money. If you want to take 100% of your personal property money that you've already been paid and flip it over into the dwelling, you absolutely can do that. It's a matter of keeping the receipts for what you're replacing after the fact and understand what the depreciation is for that particular line item that you're replacing. Again, I can't encourage you folks enough. Take your time and do what you can to get as close or over that policy limit as you possibly can, because you do not want to add having to track receipts, which could take 2 or 3 years to replace all of your personal property. You don't want to add that burden on top of everything else that you're trying to manage when it comes either time to replace the property for purchase or to rebuild that property. It's going to be very difficult. So I would say, again, don't turn it in until you're done. Be as accurate as you can possibly be. Go through it again and again and again, because you typically have a lot of money on the line. And if you've gotten everything that you can get and it just doesn't represent your policy limit, that's okay. But then you're going to be forced to keeping track of all of your receipts and applying the monies accordingly. So making sure you get that recoverable depreciation. But again, you can repurpose that money any way you choose. My policy limits, motor vehicle accessories. Does this include automotive tools? How about a vehicle lift? Okay, so that's kind of a loaded question, because it depends. Was that vehicle lift being used for personal use? Were you a mechanic? Did you do work from your home? Did you work on other people's products? Because if that's the case, then the insurance company can say that it is part of business personal property if you generated any income whatsoever. Now, if it was a lift that stored a car and you had another car parked under it, that lift would fall under business or personal property. tools fall under personal property. You would want to read the language for exclusions for car parts. Now, a lot of car parts are excluded in most policies and many policies. So again, you'd want to find the exclusionary language of your certified copy of the policy, go into personal property, and it will clearly define what it is they do not cover. And you want to read that word for word and make sure that you understand how the language is going to apply to your scenario. And again, folks, this is what we do for a living, and we're more than happy with zero obligation, because you really need to understand how to navigate some of this language if you are going to do this on your own. We're more than happy to do a forensic policy review, discuss your pros and cons, openly discuss what your options might be, and help navigate that path for you. So at least you have a little bit more information, you're a little bit more informed, you can be a little bit more strategic about your approach. And hopefully, folks, our goal is to get you to the finish line, however that, whatever that path looks like. We're happy to help. What can be done? What can be done? Life insurance company is only finding us rentals. Hold on. Oh, I'm sorry. What can be done if insurance company is only finding us rentals that are below our current standard of living? What if no comps are available for rent? That's an excellent question, folks. Look, you're entitled to what you had, and you are not obligated to take something that does not meet your needs. If you had a 4,000 square foot home, then you're entitled to a 4,000 square foot home. And I would not settle for anything less than what you're entitled to. I've had many conversations with people who had these, large, beautiful homes that were lost, and now they're living in apartments. Well, folks, you want to look at your standard of living. You want to look at long-term, not the immediate emotional, I need to get housed right now. And for some people, look, that's what brings you the peace of mind, and it removes a lot of the anxiety. I get it. I respect it. And everybody's different. But what you don't want to do is cut your nose off to spite your face, and then you get into a smaller apartment, and then 7 months into this thing, it's starting to run its course, and you're getting over this small cramped space. So again, be strategic, look long-term, always put yourself 2 years out, and you want to be able to position yourself so that you can maintain your normal standard of living. If that means that you have family members that fly in during the holidays and you want to have space to house them, you're entitled to that. Don't settle for something less than what you're entitled to, because it will run its course, a year to a year and a half down the road. I think that might be, is that it? Okay. So folks, again, here's my contact information. Certainly feel free to reach out. If there's something that we didn't cover, I'm more than happy to address it on a case by case. If you would like a forensic policy review, I and our team will be more than happy to sit with you, go through each piece of that policy with you, and really help you better understand exactly what you have available to you. Again, I thank you all for joining me. We're going to have basically a recap of this on Thursday. If you've missed anything, certainly join us again. Invite your friends and family, anybody that could use some help, benefit from this information. And overall, we're very sorry for everyone's loss. We hope that we can provide some additional information that will make this whole process a little bit easier for you. And anything that we can do to help, certainly feel free to reach out. I thank you. I appreciate you, and I wish you all well. Thanks for joining me.